Hello, everyone. It's Larry Kotlikoff here with Economics Matters. I'm delighted to have back Allan Roth, who's one of my favorite financial advisors, financial mentors, financial gurus. And Allan is humble pie. His position is that you can't become a millionaire, or zillionaire, or gazillionaire by taking risk in the market. I mean, some people can, but it's extremely rare. And daring to be dull is the operational operative direction for most Americans, almost like everybody, unless you're, you know, just, want to put everything on Bitcoin. I want to just give you a little bit of Alan's background. He's the founder of Wealth Logic LLC. His website, by the way, is daretobedole.com. And he's been working in the investment world for 25 years in the area of corporate finance. He served as a corporate finance officer of two multi-billion-dollar companies, consulted with many others at McKinsey and Company. So he has, big time experience. He's now helping individuals in their own financial planning and decisions. He's a decade of experience in portfolio construction and performance benchmarking. He's been quoted in the Wall Street Journal, Money Magazine, New York Times, Dow Jones, Market Watch. He's appeared on lots of TV and radio shows because he's much better than anybody that was on the Golden Globe Awards last night. There you go, Alan, threw you a bone. And he takes pride in being mocked on a semi-regular basis by some financial professionals for his hourly fee model. So he charges people by the hour, not by a percentage of their assets, and that gives people an incentive to try and get people to invest at risk so the assets are higher so that then they can get more money out of the client. He's also been mocked for his obvious inability to make himself rich, but that is a very rare thing, and it involves taking excessive risk. So he's the author of How Second Grader Beats Wall Street. That's 2009 and 2011 publications with Wiley and Sons. That's one of our top publishers in the country. They've been around, one of our oldest ones, along with Simon and Schuster. He writes for AARP, Barron's, ETF, Advisors Perspectives. He writes for Forbes, and other outlets. He's taught investment and behavioral finance at the University of Denver, Colorado College, the University of Colorado at Colorado Springs. Currently teaches continuing education classes to CPAs, attorneys, and CFP for their certificate programs. And despite the many credentials he has earned, he's a CFP, a CPA, an MBA. Allan claims he still keeps investing simple. His professional goal is to never be confused with Jim Cramer. So I don't think anybody's going to confuse you, Allan. Welcome to Economics Matters.
Thank you, Larry. It's a pleasure to be here again.
Yeah. So I think what we plan for everybody today is to have you take us through a PowerPoint presentation of how to avoid investment mistakes. And I'll be interrupting you along the way to raise questions or throw in an extra tidbit or two. But why don't you go ahead and take it away, and we'll go through this for 45 minutes, an hour. Okay?
Sounds good. Please do interrupt me.
Great. And Happy New Year.
Happy New Year to you. I didn't see Golden Globes yesterday, though.
Yeah, I didn't really watch it either. I just watched the whatever the host. I guess she was dumping on all the participants there. She was roasting them. So anyway, that was
Okay.
Yeah.
Can you see the slide now?
I can. Yeah. Go ahead.
Okay. Terrific. I love it when things work, which is rare. Anyways, yeah, I'm going to show just mistakes that I see investors make all the time, and even sophisticated, probably maybe especially sophisticated investors. So I'm going to go over seven: buying high, selling low, forgetting arithmetics, chasing shiny objects, confusing knowledge with unique knowledge. If I know something the rest of the market already knows, it probably has negative value. Suspending common sense, creating complexity, and confusing speculation with investing. So I want you to uh, ask questions, make comments, anything to add, anything to
I think
disagree with.
I'll say one thing that I just did a piece on my larrykotlikov.substack.com that anybody can get a free subscription to if they just want to email me at kotlikov@gmail. You get a free lifetime subscription to this, which is just the newsletter and podcast that you're now seeing. It's Economics Matters, but it's larrykotlikov.substack.com. So one of the things I wrote about was an article or a short piece that Thorsten Sloke from Apollo. He's the he's the chief economist at Apollo Investments. He wrote a piece, I guess it was in December, and then I followed up and what I wrote, showing using S&P data that the advisors, the money managers for the 3,000, 4,000, maybe 5,000 equity mutual funds in our country, 90% of them are systematically underperforming the market. So the big question that people should have is whether you're getting value from your advisor or whether you should be just doing this yourself using the right tools. And I think most people know that I have a software tool called Maxify Planner that helps people think through their investing decisions. I just talked to I've been doing a lot of investing, or not, I don't give investment advice because I'm not registered to do so, but I've been doing a lot of financial education with financial planners who don't trust their company software um, that they're using. And then I talked to them, and I just got off the phone with one person who was paying about $40,000 a year out of a discretionary budget of about 100,000 for having somebody manage his money and his wife's money. And it was clear that the person had put him into very risky nominal bonds that were going to be subject to inflation risk. Nominal bonds just lost 25% of their hot dog purchasing power over the last 5 years, cumulatively speaking. So why anybody would put anybody into fixed securities at this point, given that tariffs might dramatically raise prices? Well, not dramatically, it's not going to double, but we could have inflation going up from 2.7 and to around 5, 6 again, 8 even, given the policy that's likely to come down from Washington. Anyway, that's my 2 cents to add. Whether it's a mistake to have an investment advisor who's not Allan Roth.
Well, look, I'm a little different. I do a one-time plan for people with the goal of being fired. But
Okay.
anyways,
Yeah, go ahead.
the mistake I was trying to show is, back in when I was in business school, that was a long time ago, but I was taught you can't time the market. And that's one of the many things, by the way, in business school I've learned that was wrong. We humans are actually really, really good at timing markets really, really poorly. And I can't predict markets, but we really are predictably irrational. What I have here is just a chart of the total return, including dividends, of the Vanguard Total Stock Index Fund. And if you look at when money was moving into stock funds, when money was moving out of stock funds, we time things incredibly brilliantly. We buy high and we sell low. And I can tell you that it works out better if you do the opposite. If you develop an overall asset allocation, stocks tank, guess what you have to do? You have to buy, which is a very hard thing to do. Stocks go up, you have to sell. We forget arithmetic. When people came back from Las Vegas, I used to ask them if they won money, and then I would keep track of it. And two-thirds of the people said yes, they won money. Does anyone believe they build those billion-dollar casinos to give money away? So we can all claim that we're beating the market. But simple arithmetic, if the market earns 10%, and this was back in the book, fees have gone down a whole lot since I wrote that in 2009. But if the average person's paying 2% in fees between the advisor, between the funds, um, then they're going to get 8%. John Bogle, the founder of Vanguard, called it the cost matters hypothesis. William Sharp, I think it's the most brilliant two-page paper ever written. The arithmetic of active management proves it. And we do not live in Lake Wobegon where 90% of us are above average. So I would argue you can have an inappropriate low-cost portfolio, but you cannot have an appropriate high-cost portfolio. It is a zero-sum game from what the market will earn.
Yeah, that's what I was just saying. I mean, I have this guy I was just talking to, very financially savvy, has an investment advisor. He's telling me about these exotic securities. He's telling me about the fee he's paying, and it sounds like it's 40K a year or so that he can't really afford. And then I said, "Is this your cousin? Is this your golfing buddy?" No, but I've been investing with him for 35 years, and I said, "Well, is he making a mint?" He said, "Well, he did like a 20% return this year." I said, "It sounds like he underperformed the S&P." And so now it got him to think about, does he really want to give this much money to his advisor or give that much money to his kids? Uh, and uh, and every conversation I have with advisors, because they do come to me, and I generally am not doing this for anything at all because they're friends that I've known for a while. So I take them through our software, and then we have a conversation about their investing, and it's some relative or friend or golfing buddy who's got some fabulous security out of the zillion out there that's got connected with some name like BlackRock, and therefore it's going to make him a mint, and it's just ridiculous. Anyway, go ahead. Let's talk about retirement for a minute. It's something Americans think about regularly. Ask yourself, how financially secure do you really feel? Do you have enough money to retire? How much is really enough? And if you don't have enough money, how can you possibly find that extra money before you do retire? These are all tough questions. My retirement software, Maxify Planner, is the powerful online planning tool that takes the guesswork out of retirement. It weighs your assets against your fixed expenses to calculate how much you can safely spend every year for the rest of your life based on when you decide to retire. And it shows you safe ways to find more money. Maxify makes a complicated problem like retirement planning simple. It's accurate, easy to use, and produces what you really seek, peace of mind. So make the smart choice and visit Maxify.com today. Don't miss this opportunity. That's Maxify with an I, Maxify, Maxify.com. Now let's get back to the podcast.
Yeah, I mean, yeah, there are good advisors and not so good advisors. And, most models like the AUM makes it harder to kind of see what you're paying and then, fees underlying and the like. But, fees really matter. Um, Investing is minimizing expenses, emotions, maximizing diversification and discipline. That's all it is. It's simple, but it's not so easy.
Right.
But anyways, another mistake that so many investors make, you know how an insect will fly towards the light and then get swatted?
Right.
We humans haven't evolved quite as far as we think we have. We chase shiny objects as well. Remember Kathy Wood's ARC Innovation Fund? She disrupted investment management and she's not done yet. Well, here you have a chart in blue of how it performed. And of course, it was the darling star until it wasn't. But when do you think money poured into that fund? When
Uh,
it was shiny at the top, just
yeah.
in time to see it perform horribly. So, it may have performed overall since inception about the same as a stock market index fund, but people lost a ton of money.
Plus,
And here,
if they hold on, they had to pay fees to her, right?
well, those were after fees.
Those are after fees. Okay. Yeah.
Those were the net returns.
Right.
So, if you had bought it, right when she launched ARKK, the ARK Innovation Fund, you performed about as well as the market. But very few people did that. Most people bought it at the top just in time to get swatted.
Got it. Yeah.
And here you have a chart of Morningstar's most recent Mind the Gap data. So we all know that those mutual funds, the ETFs with higher fees, underperform markets. But we humans underperform by worse because we put money into the mutual funds or ETFs that have performed the best. So this is showing. And by the way, look at how the narrower funds have a bigger gap because those are the ones that can earn way above the market or way below the market. So, on average, we underperform the funds by about 1.1% per year. It's
So
not nearly as bad as what Dalbar showed, but
talk us,
Dalbar,
yeah, talk us through the bars on the right. Exactly take us through one of these things, like sector equity, or for example, if I
okay,
look at, yeah, go ahead.
sector equity, might be betting on energy
Yeah.
or consumer discretionary. And what this shows is that over this 10-year period, the average investor got a 7% annual return. The return of the funds themselves got a 9.6% return. So the average investor underperformed by 2.6% by going into that sector after it had performed really well, just in time to see it not perform well. So it's similar to what happened to the ARK Innovation Fund, but the ARK Innovation Fund was an extreme example.
This is a matter of timing. Uh, the people that so it wasn't that investors here went in at at the beginning and stayed in, but you're saying that people went in and out and earned 7% as opposed to sticking with a fund for that whole period of time, 9, 10 year return, cumulative return, or I guess the geometric average return was 9.6%. So
Exactly. The geometric average versus the dollar weighted return. The dollar weighted return was 2.6 percentage points annually less than the geometric or the fund return.
right, and part of this is also fees or not, or loads.
No, that's not fees or lows. This is comparing how the investor did to the fund. So the
Okay,
fund itself also underperformed the index, typically by the best estimate is the fees.
which might be 100 basis points or 50 basis points or
I think the average, because this includes ETFs as well, so the average is, I would guess, somewhere around 60 bips, 0.6%. But it's the same if I go back one slide, you can see Kathy Wood's geometric return since the inception was about the same as the stock index.
right.
But the dollar weighted return would be way negative because people poured in just in time to see it perform horribly.
I see. You're right.
So
Okay.
this is essentially saying that, the ARK Innovation Fund may be an extreme example, but here's a more systematic review by Morningstar. This isn't my work, this is Morningstar's work showing the underperformance.
This is really just a different way of saying is that people go in at too high a price, and then and because of that they're following the shiny object, which is the increase in the price of the security, and they buy high and don't do as well.
Yeah, like heat-sinking missiles, we go into we lock into what has performed well in the past just in time to see it perform poorly going forward. So then we sell and move it to what had performed well in the previous year or two.
We keep chasing our tails. Okay.
We are not logical, rational animals. When I went to business school, I learned economics, supply, demand, it all assumes we're logical, rational human beings. And I don't know how I could have bought that hook, line, and sinker. Along came Daniel Kahneman, Richard Thaler's behavioral finance, and we are emotional beings.
Right.
Another thing we do is we confuse knowledge with unique knowledge. The markets are stupid. I'm smarter than the market hypothesis. I don't want international stocks, with two wars going on and so much turmoil. I think that might have been the reason why international has lagged, or part of the reason, anyways, why international has lagged the US by so much. It's already known to the market. And by the way, tech is another reason. Tech and AI, very, very US centric. It's not always going to be that way. I don't know when things are going to change, but it will. AI is going to change the world. I want more NVIDIA. Okay, I think that's the reason why NVIDIA went from an idea at a Denny's to almost a $3 trillion market cap. I think we already know this now. And by the way, I bought NVIDIA at its at its IPO date because it was part of my total stock index fund. I didn't know what NVIDIA was then, but the Fed is going to lower rates. I know stocks and bonds are going to increase in value. Guess what happened when the Fed started lowering rates last year? The 10-year Treasury mortgage rates went up, already priced into the market.
So another way of saying this is that all these stories that you hear every day in the in the newspapers or in the online or watching Kramer, these are stories that if they were it's about information that's already out there, and it's only new information that can change the market. So information that's out there, the market is pretty damn rational in the sense that it incorporates all the information that's out there in the price of the stock. So it's only new information. So you can't say, well, the Fed's lowering rates, they're going to meet tomorrow, and therefore I know that stocks are going to go up or down or whatever, or bonds are going to go up and down, because everybody else knows this is going to happen, and whatever would systematically be connected with that policy change is already built into the price of the security. So to think that nobody's going to act and you're going to be the only one that's going to act after the Fed moves and you're going to make the killing or whatever the profit, it's hubris. Uh, yeah.
Yeah, I call that following the herd.
Right, right. Okay.
Larry, you're a really nice guy, but if I knew how to beat the market, what the top stocks were, I wouldn't tell you. I might invite you, fly you out on my private jet to my home in Aspen, but
Please.
I wouldn't give you my secret sauce.
I'm I'm waiting for the invite.
Okay, it might be a long wait.
Okay.
What will markets do going forward? I can't even explain the past. Here you have 2020. Remember that horrible year when COVID hit?
Right.
Between February 19th and March 23rd, stocks lost 35% in 33 days. I mean, horrible things were happening. That kind of makes sense. But we ended up 20%, positive 20% for the year. And, we go back and rewrite history. Well, we made so much progress towards the pandemic, coronavirus, et cetera. But, we were a long way from being out of the woods in 2020. The economy was in horrible shape, but stocks went up by 20%. I once asked you, Larry, why in 2022, real interest rates shot from roughly -1% to +2%. And you gave me the best answer I've ever heard. Do you remember what it was?
No.
Reasons unknown.
Okay. Yeah, no, and the current 30-year tip right now, this minute is yielding 2.44%. It was, as you're right, around 1999, 1998, negative 50 basis points, negative 0.5%. Uh, and nobody quite knows. These are, obviously there's a risk premium, uh, and you would think that the world was riskier right now, so that when there's risk, you would go towards this, but more people would want to allocate their portfolio towards safer things. The safest security is this 30-year tip. And so its yield should be low and its price should be high. But right now its price is low and its yield is high, even though we have Ukraine, we got Putin threatening nuclear war. We've got China's encircling Taiwan with a big navy, and a couple weeks now, during which it would be ideal for Taiwan to be invaded by China. We have the Middle East, where uh, who knows exactly where that will end up, because we saw the Houthis basically blocking off the Suez Canal. And are we going to have a war with Iran in 2 weeks? Uh, and the Houthis, and what's all the stuff is huge uncertainty. We also have AI and its impact on the economy, and one of the big questions there that's uncertain is, let's say you have all these robots coming along or smart machines that kick everybody out of their jobs, then who's going to be able to buy the products that these smart machines can make? Okay, who's going to be able to buy that driverless car or even rent that driverless car, which is a combination of code and capital? So I have a paper called Robots Are Us at kotlikoff.net with Jeff Sachs and a couple other of my former grad students that shows that, you know, uh, this these kinds of technological booms that lead to automation can lead to a boom in the salaries to the tech industry and to other people that have to uh, take jobs that are now being would otherwise be done by those people who are now, moving into the tech center. And there's a boom, but then there's a bust because over time the technology gets built up, and now you have new software engineers who are competing with the dead ones. So that's where this idea, robots are us. The robots actually embed dead former engineers who put the code together years ago, and it's sitting inside the robot. So that's in the sense in which robots are us. And what happens in this model, very simple model, is that uh, wages go up, there's a boom in the economy, then now you have new engineers coming along competing with the dead engineers embedded in the robots, their wages fall, the economy, young people uh, are out of work or out of good work, they don't save as much, there's less capital. And so output, like think about Waymo, that car is a combination of the capital, the physical capital, and the code. So you have more code, better code, but you have less capital because there's been less accumulation of capital because of saving going down. So yeah, in the long run, you have the entire economy being worse off than it started. Uh, that's that's the uh, that's one of the risks that are sitting out there uh, that people are not somehow incorporating in the price of 30-year chips.
I tell people that I don't know the future, and that's the most valuable advice that I'm going to give them. It's amazing that I can charge a pretty darn high hourly rate to tell people that I don't know the future, but it really is the best advice. I can't even explain the past. I'm not about to predict the future. Certainly, it has a lot of risk, but can you imagine had the market been down 30% last year, what the headlines would be reading? market falls due to wars, potential, um, China, Taiwan, it would explain why the market was down. And it'd be easier to explain why the market was down last year than what really happened with the market being up about, what was the S&P total return, up around 25% or so.
Yeah, it's going up 50% over the last 2 years cumulatively. And you're right. Everybody is a great after the fact explicator of what happened. They all have their
Hindsight bias. It was obvious.
obvious, yes, but but could they predict it? No. Uh, so we have all these stories that we're hearing every day hitting us. We've got 350,000 advisors who have to have a story to tell their client when the client calls. They have to sound like they know what's going on in the markets. But to say that it's random, that nobody can predict it, uh, that we have some underlying trend in the in market, and like this, the stock market has yielded over time a great like 7.5% real return on average, but with lots of variability, and that variability is unpredictable because it's based on new information. That's a whole essence of new information. It's not predictable. It's if you knew it, it would be old information, but new information is coming in a second from now, and nobody knows what it is, and that can be positive or negative. Yeah,
Few things I know. Capitalism tends to create value, so I believe in markets.
right.
Um, I know that it's better to pick an overall asset allocation, which forces you to buy when stocks are down. And boy, I'd be lying through my teeth if I told you buying stocks in March of 2020, buying stock index funds, was an easy thing to do. It felt like throwing money away. We'd never had a pandemic before. Um, but anyways, we suspend common sense. Larry, I can get you all the upside of the market with no downside risk, plus a 10% bonus, but I need you to wire over the funds today.
Right.
If we could really do something like that, can you imagine um, all the money would have flowed into products like that? 143-page disclosure document. How can I tell you that it's bad for you without even reading it? Do you know how?
How?
Do you think that the attorneys and actuaries wrote it to protect you or to protect their firm?
Yeah,
Common sense.
sure.
Market gurus on TV or newsletters. Larry, if I knew how to beat the market, I wouldn't be try to hawking my market newsletter for $199 a month. I'm sorry, a year. But by
Right.
the way, if you use the code Kodlikoff, you get a 20% discount, but only if you sign up today.
Right. Yeah,
So
obviously, all these people that are geniuses and they want to sell you their elixir, financial elixir. If they were geniuses, they would be Elon Musk. I mean, they would, or whatever. They wouldn't be engaged in this business of trying to scrape by selling subscriptions. They would be, on their yacht, right? Retire.
exactly, yes,
Right.
that was the point.
Yeah.
But anyways, creating complexity, with the number of securities, a 50-page monthly statement. Do you know how many stocks one total stock index fund and one total international stock index fund owns? Over 10,000 stocks, simply. 43 different accounts. Yes, I mean, taxes create a lot of complexity. You need, different wrappers like traditional, Roth, taxable, etc. I've always said investing is simple. I never said taxes were. So admittedly, taxes create complexity, but we humans tend to create even more complexity.
Yeah. Just to say, I had one of my relatives who I was just helping with they were uh, investing with some cousin and who was charging like 1%. They were spending like 40K a uh, a year rather than giving the money to their uh, kids or doing something else, going on vacations. And so he sends me their investment portfolio, and this advisor had put this couple into literally about 30 different mutual funds. And, when you look at them, they're basically some combination of the S&P and a bond index. Uh, and each one comes with a load, and then there's a fee on top of that the relative is charging. And it's clear that this is no different fundamentally the uh, uh, from just holding the market in some proportion between bonds and stocks. And even I think nominal bonds are quite risky to inflation. So I'm a big fan of inflation index bonds, given that they're yielding a very high return, as we just described, apart from above inflation. So, I mean, the idea that this is like just uh, having more and more of these funds that are basically identical in terms of their risk return properties because they had lots of securities in each one, and their equity uh, and fixed income. To think that they actually had any extra value, she was providing more of these having their money invested in so many funds in order to show that she was managing a lot of things and that she was handling this complexity. She had made the complexity to to persuade them that she actually was doing something. Now, the dirty little secret that economists know from our studies is that you could take a dart and throw against a dartboard, choose like 30 stocks, and if you're just talking about stock investment, and you held those stocks over time, you would do essentially the same in terms of risk return trade-off over time as if you had the entire 6,000 stocks out there in the market. The
Yeah, that was Burton Malkiel, the chimps throwing darts, and I actually told him I thought what he wrote was disparaging, and he owed the chimps an apology because the chimps work for bananas, not for 1% going forward.
Yeah, but the thing about this is that there's this technology of diversification. It doesn't take a lot of securities to be very diversified. The diversification is there's a very high increasing returns to scale to having extra securities because they're not moving together. So you can get a lot of diversification with very few securities. Now, since you can buy all the securities at 3 basis points from, for example, Vanguard, all the stocks in the marketplace uh, for nothing, you might as well hold them all. Uh, but the idea that you need to have 40 different mutual funds that had, well, this fund was a slightly different from that one and slightly different from that one. Fundamentally, they've got the same risk return property.
Yeah, actually, well, what I found is when I benchmark, um, complex portfolios with, dozens of holdings, to their appropriate total US, total international stock index fund, they perform worse by more than the fees would have predicted. And they're actually less diversified. I remember during the dot-com bubble, somebody came to me and said, I thought I was diversified. I was in, 10 different Janus funds. Well, each of those Janus funds were in the same dot-com companies that
Right,
crashed and burned.
right,
Last year, um, the vast majority of the return of the market, the majority anyways, came from, again, the Magnificent Seven. So you could have a lot of securities, but miss out on the Magnificent Seven or underweight the Magnificent Seven. And if I knew what next year's Magnificent 10 or 12 or 23 would be, again, I'd have that house in Aspen and airplane.
sure.
Anyways, we confuse speculating rather than investing. Investing is betting on capitalism, not taking any uncompensated risk. Gold, crypto, my favorite are commodities. Do you know how much money has ever been made in the futures market? And by the way, for most commodities, precious metals are the exception. I can't buy oil because guess what? I can't put an oil storage tank in my backyard. There's some environmental concerns there. Um, so what we do is we buy futures or we buy funds that are buying futures. Do you know how much money has ever been made in the futures market before fees?
No, tell me.
Zero. If
Okay.
I'm Southwest Airlines and you're Exxon, we both benefit from stabilizing prices, but on average, we're going to make zero before the fees.
Oh, okay.
Case study. Normally, I don't name the person when I do a case study, but I will this time because it was me. Back when I graduated undergrad, I thought I knew everything. I knew that, oh my gosh, we're printing all this money. Fiat currency is going to be worthless. Gold had just fallen from about 850 to 684. I thought I was buying low. I thought I would be brilliant. 44 years later, I made $16,000, which was less than inflation. I can buy fewer hot dogs than I could have back then. Not only that, but when I sell it, I have to pay taxes on it.
Right.
So, had I not been sleeping under a bridge and heard of Jack Bogle and his S&P 500 index fund, any idea of how much more money I would have had I not invested in gold, had I not speculated?
Well, so 680 for 1980. Are we D? We're talking about,
We are D. We're getting close to $1 million mistake now. Oops.
oh my God.
So what
One,
was I guilty of? Buying high, selling low. Maybe not the arithmetic part because it didn't come with fees. Chasing shiny objects, literally shiny.
yeah,
Confusing knowledge with unique knowledge. I wasn't the only one that knew that we were printing all this money and the like. Suspending common sense, creating complexity, yet another holding, and confusing speculation with investing. I should have bet on capitalism. The power of compounding was getting pretty close now to $1 million mistake.
well,
This guy is an idiot. You should never have him on your show. Um, Anyways, in 8 words, just to wrap up, like I said, investing is simple but not easy. Minimizing the expenses and emotions. And emotions are fees too. I can panic and sell a total stock index fund just as easily as I can any other fund. Maximize the diversification and discipline. In my friend Dan Ariely's words, we humans are predictably irrational.
yeah.
And by the way, if you
Huh?
don't take these things into account and Maxify in any financial model and any financial plan, garbage in, garbage out. The assumptions matter.
Right. Now, a lot of people, because they feel like they can't control themselves, they're they go to an advisor because they think the advisor will, you know, psychologically handle their psychological problems for them. And some advisors are, quite disciplined, and but then other advisors are suffering from the same psychological issues, right? They,
Yeah, I actually wrote a piece on this. Um, this was a long time ago at an FPA conference. TD Ameritrade made a terrible mistake. They showed when money was flowing into funds and when it was flowing out of funds on their advisor platform.
uh-huh,
And
yeah,
overall, and these were the good guys, the fiduciary advisors, on the TD Ameritrade is now Schwab. Um, but the performance chasing was far more than individuals without the advisor. And think about it: if you're my client, stocks are going way up, and I've got a conservative investment, then I'm going to get a little, you're becoming a little disgruntled because your neighbors are earning more. So I'm going to put you in a riskier portfolio. Then stocks plunge. And I'm not only afraid you're going to leave me, I'm afraid you're going to sue me. So this has never happened before, Larry. Let's get more conservative. Let's sell the majority of our stocks. And then when things settle down, we'll get back into the market. So, in other words, advisors as a whole performance chase at least as much, if not more, than individuals without an advisor.
Right, yeah. And then we know that the advisors that do the stock pickers who do well, think about people running stock mutual funds. If they overperform the market and on average 90% underperform the market in a given year, according to this recent study that's based on S&P data that I wrote about again in larrykotlikov.substack.com. So the ones that overperform, if you look at how well they do in the next couple of years, they underperform because they drink their Kool-Aid. They stick with what worked this year, and it doesn't necessarily work for the next couple of years. They were lucky, and they thought it was their genius that led to the answer. So
Yeah,
how?
there's no persistence. And if you think about the probabilities, if you have thousands and thousands of funds, some are going to beat the market 10 years in a row just due to random probabilities, not due to, Bill Miller was a beautiful example of that. Something like, was it 16 years in a row? I don't know if I have that number right. His Legg Mason Value Trust, beat the S&P 500. Money poured in, and guess what happened? He bet heavily on finance, on financial stocks, just in time for the 2008 market crash. How much lower could he go? He doubled down, and guess what? Found out how much lower they could go. So again,
So you invested with him maybe halfway through or at the top, and you lose everything pretty much.
yeah, I didn't. But I
So
remember teaching, people would say, was there enough data to support that Bill Miller really had beaten the market? And I said, not yet, but it's getting close.
what about Warren Buffett? I mean, we've had periods where he's done magnificently over his whole career, but there's been 15-year stretches where he underperformed the S&P. Uh, do you think he's got something unique in the way he goes about it, or is there a lesson to learn from Buffett's experience?
I think he certainly did. But remember that Warren Buffett, had access to information, maybe not insider information, but if Warren Buffett picked up the phone, to call the CEO of Coca-Cola, probably going to get through. If I pick up the phone and try to do the same thing, I'd be really lucky to get to investor relations.
Right.
But I think the last time I looked, his performance was right about over the last 10 years, and I'm going off of memory, right about the S&P 500. But
Yeah.
don't forget Berkshire Hathaway, that information is already priced into the stock.
Right. So they're charging for
Great
what?
investor. He really is a great investor, and perhaps I do think that he has skill, but that skill is already known to the market, and the only way to invest in Warren Buffett is to buy Berkshire Hathaway, or it's also part of a total stock index fund, so therefore I own some Berkshire Hathaway.
Or another way of saying this is that if you want to have Warren Buffett invest for you, you have to pay for it.
Yeah,
And it's not coming. So after you pay for it, you're not getting a $5 apple for $2. You're getting a $5 apple for $5.
yeah, and I own Berkshire Hathaway in my total stock index fund.
Right. It's one of the companies. So tell us how you invest, if you would. I mean, do you have any kind of general uh, recommendations based on your own portfolio about people going forward? Uh, this is not in terms of beating any of these markets, but in terms of diversification. And obviously, you've said stay away from Bitcoin, stay away from gold, stay away from commodities, uh, invest in capitalism. And
Hmm.
so capitalism is worldwide. And so that means, but if you invest in US companies, I think about 40% of their revenues are coming from abroad. So investing in US, let's say the S&P index at 3 basis points, or the whole stock market, US market at 3 basis points is going to give you a pretty good holding of international capitalism. Would you go beyond that to buy international funds? I'd like to talk to you about a really powerful financial planning tool to help you make smart retirement and other critical financial decisions. It's a tool that factors in all your financial data and shows you what you can sustainably spend every year for the rest of your life. That tool is my software company's Maxify Planner. It's incredibly powerful, it's accurate, and it's easy to use. Maxify takes the guesswork out of financial decisions at every stage of life. Its focus is on raising, de-risking, and sustaining your living standard. Maxify lets you run what-if scenarios to see how your finances will change in taking new jobs, buying a home, doing Roth conversions, retiring early, downsizing, investing more in the market, you name it. Knowing the impact of these decisions before you make them is the secret to making smarter decisions. And it's also the secret to what we all seek, which is financial peace of mind. So please visit Maxify.com today to start planning. That's Maxify with an I, Maxify.com, Maxify.com. Now let's get back to the podcast.
Absolutely, I would. Now, have I been wrong? Yes. But, I think I first met Jack Bogle 22, 23 years ago.
Okay.
And, one of our discussions was on international. And he gave me two arguments why to avoid international. And that was one, you had enough international diversification with foreign revenue from S&P 500 stocks. But the argument that I gave him is the same one I'm going to give you. If you had enough diversification, you wouldn't see such humongous differences in performance of international versus the US. So when I wrote my book in 2009, I said, 1/3 of the stock exposure should be international. And the typical response was, why only a third? All the growth is going to happen overseas. Guess why they were saying that? Because international had performed so well.
I see.
And now international is performing so poorly. It's not that international has done that horribly. It's that the U.S. has done that incredibly well over the last dozen years
Would
or
you
so.
stick to 30% of your total equities in international or something like that?
Yeah, I believe in about a third. But with that said, I'll let the client pick whatever they want, but they have to commit to stick to it. So in
Okay.
other words, if international starts performing better again, they can't then increase their exposure. They've got to rebalance. Because again, performance chasing is a natural human instinct, fear and greed, fear and greed, repeat till broke.
Right. Okay. The and what about bonds these days? What about
Well, Larry, as you know, I'm a big believer in tips.
right. I know
Not,
we've
in
discussed this.
creating not buy a 30-year tips and hold it, but by building a tips ladder.
Yeah, we our last podcast was you're talking about tips ladders, and then I've had a couple podcasts since then with uh the creator of tipsladder.com.
Evan Essler, yeah, brilliant guy.
Yeah, and we're going to incorporate his tool in our Maxify planner tool this spring. So we've had, fortunately, it lives very close to where I live and in the Boston area. And so we've had lunch and yeah, he's a great guy. He's from Australia and
Mhm.
just a really cool guy and just there to try and help people. So,
I've spoken to him. I've had lots of email exchanges with him. I was suspicious when he came out with his model, what's in it for him. And I think he's just a boglehead doing it to help people. He's just a wonderful guy. It's a beautiful tool. Um,
Yeah, so my most recent podcast, which is uh, about his updated tool, will help anybody take a see how to use his tool. He can be a little bit cryptic in describing it and but we walk through it very slowly, and I think anybody then can use the tool to see what they would buy to build a ladder. And the ladder may not be a perfectly smooth stream, but if you wanted to have a smooth stream or as smooth as it can be, uh, here's how much real dollars I'd like to be getting through the next 30 years. You can enter that in and it will come back with here's how many of these different QSIPs to buy, tips to buy of these maturities. And this is going to give you back this stream, and it's under conservative assumptions that the coupons would be reinvested at a zero real return. So you might do better than that in terms of what comes back out. But it's certainly a way people can build their own tips ladders without much trouble. And that's very different from holding a mutual fund of tips because they're that's like, that's not buy and hold, that's buy and sell in effect, right?
yeah, I mean, I wrote a piece, by the way, a few months ago, 4 easy steps to build the tips ladder, relying very heavily on, Kevin was very helpful. Kevin Essler, the founder of the guy who wrote the tipsladder.com model, was incredibly helpful for it. But yeah, what I use it for is just to build I call it supplemental Social Security. It's not exactly the same as Social Security, but um, building a floor to a spin rate. So in other words, if you combine Social Security with a tips ladder, there's a certain amount of money that comes in. Inflation adjusted dollars. That's just a floor. No matter how the portfolio performs, you're going to get that much. If the government doesn't cut means test Social Security, we'll see what happens with that. But if they do, then the tips ladder is even more valuable. So we don't use the money that comes due each year, which is a combination of the coupons and a tips maturing. We use it for money to live on.
Yeah, Maxify is saying here's how much you need to withdraw from your regular assets and your retirement accounts to maintain your living standard. And so it's giving you, in effect, the kind of, if you want to immunize those withdrawals with a tips ladder, but it wouldn't be getting a smooth stream, which Kevin's tool can do, but it can produce an irregular stream, which his tool can handle too. So you say exactly, put in the withdrawals I wanted to get out from my regular assets, and then this is saying, well, if you wanted to immunize those with your then you buy these this set of QSIPs, this number, and it will get you this irregular stream that corresponds to the withdrawals from Maxify because you could be having money coming in, money going out, but you're trying to maintain your underlying living standard. Same thing with the retirement accounts. So, anything else to add before we say farewell for the moment and get you back on in a few certainly within a year, I hope, to talk some more.
Well, it's been a pleasure. Nope, I think that's it.
We've done a good job. Okay.
Thank you very much, Larry. It's been a pleasure.
Okay. Well, this is terrific. And yeah, everybody I think should listen carefully to Allan's common sense advice. And you should go to it's daretobedole.com. And if you really want to have someone who to lean on in terms of you feel a lot of people feel just too nervous to handle their finances. Allan is a fantastic resource, and he's going to charge you by the hour. And it's not going to be that he has an invested interest in trying to get your portfolio to get bigger take the risk that it's going to be bigger, so then he can charge you more money through time. Uh, and That's, going to be a strategy for, if you think about it, the market has a trend and it has upside and downside, so if you put kind of half your people in, uh, if you put people into overly risky securities, then it could well be that on average, if you're charging a commission, you end up better off in terms of making your own money, than, because you'll lose some people who are do poorly. But let's say you put half in these risky assets and half in those, and you lose, and the ones that do poorly, you lose, the other ones you keep, and then of those, you put half of those through time and risky, and these risky assets and others that are also risky, but they do poorly. So you keep sticking with the ones who do well. Well, then they start really believing in you, and then they start telling their golfing buddies, and now you are off to the races of being a fantastic investor because nobody has heard about the losers that you invested in. It's all the stories are about the winners. So there are strategies I'm sure that the industry is using here to jack up their assets under management over time. But anyway, this has been very, very useful for everybody. Thanks again, Alan, and we will farewell in the new year. Okay.
Yeah, my pleasure. I hope all the viewers have a wonderful, exciting new year, just not in your investing.
Okay. Yeah. Exactly. All right. Take care.
Take care. Bye now.